In the late 1990s, the U.S. telecom world felt like an endless growth story. New cables, new customers, new internet traffic, everything seemed to point upward. WorldCom, built through aggressive expansion and high-profile acquisitions, became one of the most talked about names in long-distance and business communications. The company's size and momentum were real, but so was the debt and complexity that came with rapid deal-making. By the time the broader market mood began to cool, WorldCom was carrying heavy financial expectations, both from Wall Street and from its own internal forecasts. As competition intensified and pricing pressure rose, the easy wins became harder to find. Revenue growth slowed, yet the market still expected WorldCom to deliver steady earnings results quarter after quarter. Inside large public companies, that kind of pressure can quietly reshape behavior. Leaders begin to treat targets not as goals, but as requirements. When that mindset spreads, the organization may start measuring success less by long-term health and more by whether the next report looks right. It's not always dramatic in the moment. Often it begins with small rationalizations, temporary adjustments, optimistic assumptions, a belief that performance will rebound soon, and that today's choices will be corrected tomorrow. WorldCom's situation was not just about one quarter's results. It was a multi-year pattern of struggling to maintain the image of predictable growth in a volatile sector. As internal strain rose, decisions moved away from transparent reporting and toward managing appearances. This is where financial reporting stops being a mirror and starts becoming a costume. To understand what happened next, it helps to keep a simple idea in mind. Financial statements are not merely paperwork, they are a public trust system. When that system is bent, the damage is not only to investors, but also to employees, partners, and the broader credibility of markets. The WorldCom story became a defining example of how a respected public company can drift, step by step, into major reporting failures when incentives, culture, and oversight no longer protect the truth. By 2002, the gap between WorldCom's public image and its internal financial reality had become too large to sustain. The stage was set for a reckoning, one that would not be triggered by a single headline moment, but by the persistence of people who asked a basic question: where is the support for these numbers? WorldCom's reporting problems were not about a mysterious technology or a hidden engineering trick. Investigators later emphasized that the scheme relied on accounting entries, ordinary-looking adjustments inside financial systems, used in a way that did not match proper reporting standards. That detail matters because it shows how powerful accounting classification can be. the same cash spending can appear very different depending on where it is recorded. A central issue involved line costs, large fees paid to other telecom carriers for using their networks. In normal circumstances, many of these costs are treated as regular operating expenses because they are part of the ongoing cost of delivering service. But WorldCom recorded substantial portions of these line costs in a way that made them look less like current expenses and more like long-term assets. When a cost is shifted out of current expenses, the immediate reported profit can appear higher even though the underlying business hasn't improved. From the outside, the company could appear to be managing its margins successfully, but underneath, the reporting was becoming less connected to day-to-day economic reality. This kind of misclassification can be especially misleading because it doesn't require fake sales invoices or imaginary customers. It can be done through internal journal entries that, on the surface, resemble normal accounting work until someone asks for documentation and clear justification. Another reason this approach can persist is that large organizations have many moving parts. When different departments handle spending, approvals, and reporting, people may assume that someone else has verified the logic. Over time, the system can turn into a chain of assumed correctness, where the existence of an entry is treated as proof that the entry must be valid. In the WorldCom story, the mundane nature of the actions was part of the danger. The entries did not involve dramatic theatrics, they involved pressure, direction, and compliance within a reporting structure. Some employees later described how they were instructed to make entries even when they did not see full support. That kind of environment, where questioning is discouraged and speed is rewarded, can turn professional caution into silence. A crucial point for an educational documentary is this: the harm was not only that the numbers were wrong, but that the wrongness was strategically placed where casual observers might not notice. Many investors focus on earnings trends. If expenses are shifted away from the current period, earnings can look smoother than the real business deserves. This can also influence credit ratings and lending decisions because lenders assess financial strength partly through reported performance. As the entries accumulated across multiple reporting periods, the company's public financial picture drifted further away from reality. At that stage, reversing course becomes psychologically harder. Correcting the record would mean admitting that earlier reports were not accurate. That admission can feel like a cliff edge, so leadership may be tempted to continue forward, hoping the business rebounds before the truth catches up. But accounting is patient. Numbers don't forget. each reporting period adds weight to the same question: is this supported? At WorldCom, that question eventually landed in front of the right people, people who were willing to keep asking it until they received a real answer. In many corporate scandals, the turning point is not an external regulator or dramatic leak. It's often someone inside the company who notices that the story no longer matches the paperwork. At WorldCom, that turning point is widely associated with the internal audit function led by Cynthia Cooper. The role of internal audit is not to run the business. It is to test whether controls, documentation, and reporting truly hold up under scrutiny. And in 2002, scrutiny finally met resistance. The internal auditors began examining unusual accounting treatments related to network costs. What made the situation suspicious wasn't merely that the entries existed, it was that they were large, repeated, and hard to explain clearly with supporting documentation. Auditors are trained to look for patterns, repeated last-minute adjustments, vague labels, missing paperwork, and explanations that depend on authority rather than evidence. As the internal audit team dug deeper, they reportedly worked under tense conditions. When an organization is under strain, oversight can be treated as inconvenience rather than protection. Yet the team continued. The heart of their work was simple. They requested support for entries and tried to reconcile those entries with proper accounting logic. When explanations felt incomplete, they elevated concerns to those responsible for financial reporting. One of the most telling features of the WorldCom story is that the fraud's discovery did not require a new tool, just persistence. Investigations later described how the problem was uncovered through review of entries and the absence of reasonable support. The auditors did what strong controls are supposed to make possible. They followed the trail until it either made sense or led to a conclusion that it did not. As concerns intensified, the matter reached the board-level audit committee and the external auditor environment, increasing the likelihood that the issue could not be quietly managed away. Once internal audit findings are clear, a company faces a pivotal choice: confront the reality and correct the record, or attempt to delay and minimize. In WorldCom's case, the situation moved rapidly toward disclosure. In June 2002, WorldCom revealed that prior financial statements would need to be restated due to misstatements spanning multiple quarters. Regulators acted quickly. The U.S. Securities and Exchange Commission filed civil fraud charges in late June 2002, and the company's public credibility fell apart under the weight of the revelation. For a documentary audience, this moment is both sobering and instructive. Large failures are often revealed by ordinary professionals doing careful work. The internal audit team did not need dramatic confrontation. They needed access, documentation, and the courage to keep going when the easiest social option would have been to step back. Soon after disclosure, the company's ability to operate normally was severely damaged. Confidence is the oxygen of a public firm. Once that oxygen is gone, everything becomes harder. Financing, customer trust, employee stability, supplier relationships. WorldCom's crisis escalated into bankruptcy in July 2002, marking one of the most significant corporate collapses of that era. Once WorldCom's misstatements became public, the story shifted from internal pressure to public consequence. The company's disclosure in June 2002 did not happen in a vacuum. The early 2000s were already shaken by multiple corporate reporting scandals, and trust in major firms was fragile. WorldCom's revelation became a symbol of how quickly confidence can evaporate when financial statements no longer feel reliable. The SEC's civil action came swiftly after the company's disclosure, emphasizing that investors had been misled by reported results over multiple reporting periods. This step matters in an educational account because it highlights a key principle. Markets depend on accurate information. When information is distorted, the harm spreads beyond one company's shareholders. It can affect retirement funds, employee savings plans, lending decisions, and even the perceived stability of an entire industry. In July 2002, WorldCom filed for Chapter 11 bankruptcy protection. For many employees and ordinary investors, bankruptcy wasn't an abstract legal term. It was disruption, uncertainty about jobs, benefits, and the future of the business they depended on. A company can survive bankruptcy, but trust does not return easily. As investigations continued, the scale of the misstatements grew larger than the initial figures. Over time, investigators described unsupported accounting entries totaling many billions of dollars. The magnitude wasn't just a statistic, it was an indicator of how long the reporting drift had persisted and how deeply it had entered routine processes. Legal outcomes followed. Senior executives faced criminal cases and convictions related to the company's reporting failures. In a documentary tone, it's enough to say this plainly. When leadership signs off on reporting that does not reflect reality, legal accountability becomes part of the aftermath. It's not just business, it's public trust, and public trust has rules. Regulators also pursued financial remedies aimed at helping harmed investors. A notable chapter in this area involved penalties placed into a fund structure intended to benefit victims. The SEC has described how a civil penalty judgment was directed into a fair fund for WorldCom's investor victims. This matters because it shows an effort, however imperfect, to restore some value to those harmed by misleading reporting. By 2003, a federal judge approved a major settlement tied to WorldCom's accounting fraud, widely reported as a landmark in size for the time. The exact structure and distribution process evolved over years, underscoring another reality. The consequences of financial misreporting don't end when headlines fade. They continue through litigation, restructuring, and long recovery efforts. From a broader perspective, WorldCom's collapse helped accelerate reforms in corporate governance and reporting expectations. The era's scandals pushed lawmakers, regulators, and exchanges to demand stronger controls, clearer accountability, and better protection for those who raise concerns. WorldCom became part of a historical turning point, an example repeatedly used in ethics courses and audit training because it demonstrates how quickly a performance story can become a systemic breakdown when reality is treated as negotiable. A common misunderstanding about corporate fraud is the belief that it is purely a technical failure, an accounting issue that can be solved with better spreadsheets. WorldCom's story suggests something deeper. Culture often determines whether rules protect the truth or merely decorate it. When performance targets become identity, people begin to fear bad news. Bad news threatens status, stock price, reputation, and career security. Under that fear, the organization can gradually lose its ability to speak plainly. People learn what is safe to say. Questions become unwelcome. Documentation becomes an afterthought. The system continues to function, emails, meetings, approvals, yet the spirit of integrity weakens. In later investigative descriptions, the fraud was characterized as being achieved through unsupported entries, not through a hidden engineering operation. That characterization is educationally important. It implies that what failed was not technical capacity, but governance, how decisions were justified, reviewed, and challenged. Boards and audit committees exist to reduce exactly this kind of risk, but oversight must be active, not ceremonial. In a high-pressure environment, strong oversight means asking uncomfortable questions and demanding clear, documented answers. If auditors, internal or external, do not receive support for a significant accounting treatment, that is not a small compliance issue. It is a fundamental warning that reporting may be shaped by desire rather than evidence. Another critical dimension is the role of external gatekeepers, auditors, analysts, banks, and rating agencies. In many major collapses, each gatekeeper sees only part of the picture, and each assumes someone else is verifying the rest. WorldCom's case became a lesson in why distributed responsibility can lead to distributed blindness. A control system works only when every layer insists on clarity. At the employee level, the story highlights a human conflict. What happens when professional ethics collide with implicit pressure from leadership? Some employees may comply because they believe the instruction must be legitimate. Others comply because they fear consequences of resistance. Still others may sense something is wrong, but lack a safe route to report it. That is why whistleblower and internal reporting protections matter. They are not only legal requirements, they are cultural infrastructure. Cynthia Cooper and the internal audit team are frequently highlighted because their persistence shows what ethical professionalism looks like in practice. Not drama, but steady insistence on support and logic. The moment an organization treats internal audit as an enemy, it's often already moving toward trouble. In a documentary analysis, it's also worth noting the emotional trap of temporary fixes. Leaders may convince themselves they are smoothing results to buy time, but each temporary step adds weight to the next. Eventually, the company must either correct the story publicly or continue deepening the gap. By then, the gap can become so large that the only realistic ending is rupture, restatements, investigations, and loss of credibility. WorldCom's case is taught widely because it connects the abstract, accounting rules, to the real, jobs, savings, trust. The numbers were the language of the event, but culture was the engine. WorldCom is not only a history chapter, it is a practical framework for prevention. The educational value of revisiting it is to help viewers recognize patterns early, before damage grows. One lasting lesson is that earnings quality matters more than earnings size. If a company reports steady profit while cash flow struggles, or if it shows improving margins while the industry is deteriorating, those tensions deserve careful attention. This doesn't mean a company is doing anything wrong. It means observers should ask better questions. Financial truth has consistency across statements. Income, cash flow, and balance sheet should tell a coherent story. Another lesson is to watch for unusual shifts in classification and timing. When a company suddenly reports a sharp change in expense patterns without a clear operational reason, analysts and boards should demand transparent explanations. Again, this is not about suspicion for its own sake. It is about protecting the integrity of public reporting. WorldCom's misstatements were tied to how costs were recorded over time, and that dynamic remains a common risk area in many industries. For employees, the story underlines the importance of documentation, escalation routes, and professional courage. If someone is asked to process significant entries without clear support, that is not a personal failing. It is a control failure that needs resolution. Healthy organizations welcome clarity because clarity reduces future risk. Unhealthy organizations treat clarity as disloyalty. For executives and boards, WorldCom reinforces that tone at the top is not a slogan. It is a daily operational choice. How leaders respond to bad news, whether they reward truth-telling, whether they protect independent functions like internal audit, and whether they accept short-term disappointment rather than long-term distortion. For regulators and the public, WorldCom contributed to a broader push for stronger internal controls and accountability. The SEC's actions and the later victim compensation mechanisms demonstrate that enforcement is not only about punishment, but also about restoration and deterrence. The fair fund concept used in the WorldCom context illustrates how civil penalties can be directed toward investor relief. And finally, for any viewer who thinks this could never happen again, the modern answer is gentle but firm. Systems can repeat old mistakes in new clothing. Industries change, technology changes, but human incentives remain. That is why WorldCom remains relevant. It teaches that the most dangerous risk is not complexity, it is complacency. A documentary about WorldCom does not need dramatic language to be powerful. Its power comes from the quiet realism of the lesson. When truth is treated as flexible, the cost eventually becomes real, and it lands on ordinary people first. The purpose of telling this story now is to strengthen the viewer's ability to value transparency, reward ethical behavior, and recognize that integrity is not an accessory to business, it is the foundation that keeps business worthy of trust.